This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in learning more about investing in startups, launching a new startup, and need to raise funding? The Startup Funding Espresso is a daily podcast in a short, concise format delivered to your inbox every day, Monday through Friday. In the time it takes to drink an espresso, you can learn about startup funding. To subscribe, go to investorconnect.org and put your email into the pop-up box. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Brandon C. White, host and editor of Build a Business. Build a Business Success Secrets is a monthly print playbook revealing the inner game about how to build a business. Readers get monthly articles on how to perfect their mind, tune their body, investing tips, information on new and undiscovered products and services that have been tested and shown to increase sales and profits, and ultimately, how to build a successful business. The newsletter also sponsors a podcast called Build a Business Success Secrets that provides straight talk for entrepreneurs and business owners. Brandon, thank you for joining us.
Thanks, Hall, and thanks for that really kind introduction.
You're welcome. And we're great to have you here. Let's start off with your background. And what did you do before you started investing in early stage companies?
I was an early stage company. I actually started my career 2 decades, almost a little bit over 2 decades ago. I started, built, crashed, bought back from investors, and created the largest social networking site for an e-commerce site for sport fishermen on the internet. And I sold it to a large media company. Luckily, I say gratefully, in Canada, which got me to where I am today.
Great. So what excites you right now?
Oh, gosh. That's a good question. There's I'm still excited about the internet and technology. I think that I, as a tech nerd, have always, I'm not a prophet. I'm not saying that, but I've been ahead of the curve and where I think technology is going, and dug in as one of the early geeks, and then waited a long time to see that come to fruition. And I think what we're coming to see now is what I call sort of the third wave of the internet technology, where we're starting to see mature business models of e-commerce and social networks and online businesses that actually make money and can work. And I think that's a function of back in the late 90s and middle 90s, we just didn't have as many people on the internet. So you could make money, and there was people like Amazon clearly they were losing money, but they were making money, but investing in themselves. But it was hard for the early delivery businesses like Peapod and these other models out there. Today's internet doesn't look that much different to me, Hall, than the companies that we saw. It's just that we have more people. Technology became more efficient. You don't have to run your own server farm in your house and cool it with 50 air conditioners. I mean, only half joking there, which I know you remember. But and I think AI and I think that's overused term, but I think the ability to leverage big data with models that learn is getting better. And we're going to really see that within the next 10 years.
Great. Well, I remember those times well in the 90s. I used to watch pitch sessions, and startups would stand up and say, I'm building a web business. I need $5 million. But back then they had to build their own server farm and pay American wages for everything. And it was a very expensive endeavor for sure.
Well, I think it was, candidly, Hall, my bill for raising $1 million back then with, I don't know, should I say it's a national law firm, I won't say it, but was $90,000. And I think that has changed for entrepreneurs as well. So I think 9% on a $1 million raise seems high, but candidly, back then we didn't have Series C documents. We did not have the mature model. We didn't have Cooley was just getting ready. GT Law out there was playing around, at least on the East Coast in Northern Virginia. The Valley, I think, had a model, but it was still expensive. I think that is an incredible thing for us as entrepreneurs. And I should tell people out there, that's how I got started, but I was a venture capitalist. I worked for 2 venture firms, and I was an early earlier guy at America Online, and then went back. I say went back. I don't think I ever left. I think I just ignored my entrepreneurship and then went and have been an entrepreneur ever since.
Well, great. Well, you've seen a lot of startups and a lot of investors in those days. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Be prepared to lose their money. I mean, you and I laugh at that, but I think some angel investors, I don't know what you're seeing out there, Hall, as much. And you and I've talked, and you were on my podcast, and we did a panel together, so I know a little bit. But I think that the entry of unaccredited event investors is actually a really incredible opportunity for entrepreneurs. I think that segment of the population that is not as sophisticated doesn't understand the true model, which is you will probably lose more on a numbers basis than you gain. It's that when you hit the winning one, it pays back 100 times, or should, what you got. And I think, and I've experienced this. I actually had an experience with angel investors in the early days where they're like, oh, well, the company's not doing good. Can we get our money back? I'm like, no, that money is gone. And be willing to lose that money and understand, I think, Hall, and I'm not saying they didn't even teach me this in business school. I just learned it through having a family office and private foundation and things like that over many years, is that there's a certain segment of your portfolio, about 7%, that should be in alternative investments, which should include venture capital, leverage buyouts, other risky, maybe you put art into that, whatever your Bitcoin, whatever you want to put in there, but it's an alternative asset. And understand that whatever percentage of venture capital or angel investing that's in there, that's how it is. Don't take an exorbitant percentage of your money and expect that that's going to be your retirement. I think that's just important on the expectations, because as you know, Hall, been in the business for so many years, it's highly risky. I mean, there's no two ways about that. It's a high risk. You can mitigate your risks, but there's also, in the early stages, 100 things that can happen to a company that I've experienced and been an investor and seen, that some of which you can't control, like COVID.
Absolutely. So on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
One, before you need money, you should be talking to investors. When you don't need money, you should be talking to investors. So when you start, and here's my theory, I don't know if people agree or not, but I believe that you should go out there, talk to investors, and tell them your plan, your story, and then keep them up to date on that story so that they can see that you are making progress and that you have a story. And then when you need the money, you can say, hey, Hall, remember when I told you 12 months ago I was going to do this? Here's what I did. Or here's what I missed, and here's why we missed it, and here's what I learned, and here's how we mitigated that. That's maybe more important, at least to me as an investor. But the other thing that I'll tell entrepreneurs, and I've had bad experience, not because this investor was bad, but because we weren't a match for one another. I jokingly say, Hall, I've accepted in my life, that has sort of made my life better, that out of the 7.7 billion people on this earth, I accept the fact that I will not get along with all of them, and they all might not like me, and I might not like them, and that's okay. I think the same thing is true with investors. And as an entrepreneur, and being an entrepreneur, I know this is true because it's still hard to fight, is that entrepreneurs think that because an investor has the checkbook, that they're the king of the mountain. Because we want the money, because we think, or entrepreneurs think, that the money is going to fix their problems, which you and I could probably have a long discussion on, but whether that's really true or not is open for debate. But I'm getting to the point that you need to interview your investor, not just allow them. Entrepreneurs show up to angels and VCs and everybody else, and it's like we're trying to prove ourselves to get the check. Well, what I've learned, which is really hard, is you need to interview that investor because you are getting married. Period. And some life changes. You might meet an angel investor who says, "Oh, I'm just a passive investor. I'm going to give you 50 grand and, give me an update every month." And then something happens. And all of a sudden, they're a different type of relationship. So understand that. And I had such a bad relationship with one investor, mainly because our expectations were off. And I take responsibility for that. I take responsibility for not doing the diligence on the investor to know what to expect, and having wanted the money so bad, I paid him back. He didn't even want to be paid back. I mean, it was hard to pay him back because he didn't want to be out of the deal. But I think, that will derail your business. It will cause you to spend an enormous amount of time as a CEO, entrepreneur, founder, whatever the right word is, that small business owner, that you'll take your eye off of the ball, which is sales and product development, and that can hurt your business. So do your diligence on the investor. It's not going to happen over one meeting. You're going to want it to happen over one meeting, but you need to not interview. And I would say it's not an interview, it's a conversation over time. And don't just do it in an office. Go for a walk, go for a hike, because that's when you start to see people's real self, not sitting across from a lunch table that, as an entrepreneur, you never get to finish your meal anyway because they're asking you all these questions. Sorry for that, but that's really the from the battleground that I've been in. The story is you've got to interview. You've really got to do your diligence on investors because you are going to be married.
Well, that's great advice. So you've been investing for some time. How do you see the startup industry, move forward now? How do you see it evolving from here for startup funding?
Well, I think it's a great time to be an entrepreneur as it relates to crowdfunding and the access to capital. I think the danger is that you don't understand as an entrepreneur potentially what the investor can bring to the table besides money. And if you just go after the money, I'm sure that you can get crowdfunding and things like that out there. But I think that what is potentially getting lost, or the spotlight, or I don't know what we call it, sensationalism of it all, what's getting lost is just make sure that you understand that if you take those opportunities, you can get the cash, then you better have a plan to execute with it. One is because you're taking their investor and they're likely not going to necessarily help you. So I think that's an important dynamic going on. But I think it's an incredible time. It also, I think, how it ups our game as angel investors to sell ourselves more, to show entrepreneurs what we actually can bring. I have built a little media property with a decent sized email list that I can offer an entrepreneur, hey, if I'm in a competitive thing, can I get in on your deal? And if I can get in on your deal, by the way, I can send an email to over 50,000 people that I have on my list that might help. And that's a value add. So I think it's at least for me, I feel like I've had to up my game to say, here's what I bring to the table, because deals are competitive for good ones.
Well, good. And so what do you think the biggest change we'll see over the next 5 years in this space?
I think we're going to see some fallout from the crowdfunding. I think there's going to be, so what's going to happen is we're going to have some really savvy internet marketers who are going to create these really savvy companies that sound like Pied Piper from HBO, and they're not going to be real, and people are going to get burned, and the government isn't going to allow that. I hope it doesn't happen. I just feel like in situations where there's gold rushes, there's always a correction. And I don't think that correction is going to crush the opportunity. I think it's just going to help regulate it a little bit more so that everybody's protected.
Well, I see that a lot. I see many crowdfunding deals with 10K of revenue, but they're worth $25 million valuation. And I wonder how they get there, and will anybody ever get paid back? And when they don't get paid back, you think government regulation is going to solve that problem?
Well, Hall, That's an interesting one for today's episode that we could talk about for a long time. I'm not big on heavy-handed government. I think that markets should be allowed to operate. Having said that, I think there's plenty of examples in world history, not just the United States of America, but world history that show that without some regulation, people, non-savvy, unexpecting people can be taken advantage of, which for those people can have detrimental consequences of which costs us as a society. So it's not that there's no cost to that. There'll be a cost to that some way. So I see you smiling there because I'm being very politically correct, I think. But I don't think government can fix it. I don't think government candidly completely understands it unless we've got some VCs, which there's like, what is there, one U.S. Senator, Mark Warner, who was a VC. I don't know any of the other ones that were. Maybe one or two. I'm just saying, without that sort of expertise, it's very hard to regulate something you don't know. And I know we have a lot of really good government people out there who work really hard, but I just think it's going to be corrected. I don't know the government's going to fix it. I think the government's going to react is what's going to happen. And that's going to, and then we'll self-correct somehow. But, I hope it doesn't happen because I think that it's a good thing for us angel investors at some level in that we get leverage on our money.
I once heard a experienced investor say, these new investors coming in here now, they're going to lose money. And I'm not talking about angels, talking about crowdfunders. I'm talking about VCs, talking about angels back in the 90s. And when angels came up, the very same thing was happening. They were putting money into deals with too high valuations, no exit strategy, and the usual thing. And it seems like every generation just has to learn all over again how to do startup investing. And we saw the VCs do that in the 70s, 80s. We saw the angels do that in the 90s and the 2000s. And here in the 2010s and 20s, we're seeing crowdfunders are starting that curve. And when you start losing money, you start to realize, wait, this is harder than it looks. I'm doing something wrong here. And then they have to self-correct. And I've never seen government regulation really be effective at that level without hurting the existing companies at the same time. And so it just seems like the investors just have to put money in, lose it, and then realize this is not working. I have to do it better, and they start to learn the lessons from the others as well. So and everybody moves up and to the right. Angels become VCs, VC become private equity, and crowdfunders become angels, and it's the game continues on in that case. So we'll see how it works out, but I don't see a lot of these guys making money. In fact, I'll ask right up now, do you know of any crowdfunding deal that ever returned money to the investor as an exit? Not Kickstarter, but Title III crowdfunding, where it's equity. Has any of them ever made a return to an investor? You could claim, well, it's early days. It's only 4 or 5 years into it now. So
I'm trying to think. I can't think of anything outside Kickstarter campaigns for sure.
Yeah, they have, but you're not getting equity. You're just prepaying for a product, and you get that. But now for equity deals, when these get to an exit, what did that look like, and how did they pay out? And like I say, it's still a bit early days, but 2 or 3 more years from now, if we don't start seeing exits, we'll have to start seeing what actually happened. Overvaluation, I think, is the big one. People just put very high prices on it. Investors not aware that that's a key metric for getting paid back at the end of the day. But we'll see how it works out. But I think
I have a question. I have a quick question for you because I think this is worth discussing when we talk about trends. Is so that crowdfunding idea, which is fast, low diligence, invest, right? You can put it on your credit card, literally, because I tried it and it apparently. I own some stock in something. But we also have the venture business and even maybe the angel in business, depending on what you want to call it, changing with like the Tiger Fund, right? Which is high velocity. We're going to do low diligence. We're going to pay high valuations. And at least the initial returns on that are showing high. I think the risk for the good news for them is they have the money in the portfolio to do it. I think the downside is that the crowdfunding community won't do that. So I think to your point, they'll lose money. I do agree with you that I haven't seen any time when the government can actually fix it. So I just think that they'll react because these people will lose money. So I tend to agree. And I think you did a great job summarizing sort of the evolution as I'm thinking of how it really works. So they'll get savvy because they'll learn their lesson that they should ask for the document and find out what type of class stock they got and where they sit in the cap table. And if they don't get that, then they're going to be in big trouble.
Absolutely. So let's talk about your investment thesis. You've been investing for some time. What is your thesis, and what exactly is your criteria for making an investment?
Well, what I tend to like online businesses, and I like technology businesses. I've done an enterprise software company. If I were to invest in an enterprise software company, I want to see a repeatable sales process because I learned from pain that it's a long sales cycle. But I'll tell you, one of the key components for me, Hall, in investing is I want to see how big their email list is. And the reason is I tend to invest more in consumer type businesses. I'm open to B2B, but even in B2B, I want to see what that marketing engine looks like. I think too many times where I've lost money or where I've seen companies fail is that they believe that they're going to raise money and advertise their way into customers. And I don't think that you can buy your way based on your customer acquisition cost and ARPU today, mainly because the platforms you're going to advertise on Facebook, Instagram, or Google for the most part. If you're doing an Amazon product, you can certainly do that on Amazon. I think there's tons of players in that Amazon market that drive your costs down and basically starve you out of business on product in that specifically. But if we talk about the other platforms, the prices for most of the categories are relatively high. So buying your way into an app download doesn't work for me. I want to see a more, I'm looking for a more, almost old school marketing technique that works, meaning either direct mail or email list, because if you have an email list and you've gathered that audience, whether you're doing lead magnets or something like that, you've got a customer base that you can talk to, that you can control, because that way at least you can communicate with that audience regularly. So my biggest thing is that I want to see the email list, and I want to see some level of understanding of how they're selling their product. Of course, all the other things matter, right? Cost of product, your production, your people. But I'm really interested in the channel of how they're going to sell that product. And I look for people who are building their email list.
Great. Well, so you see a lot of startups out there. What do you think is the main challenge startups today face in launching their business?
Well, I think the barrier to entry is so low these days, and that it's really just execution on the plan and staying true and not getting off track. I think the other challenge is how are you going to do that marketing online through all of what unique thing are you going to use? Do you have SEO, or do you have that magic? Because there is a big flow online, which is creating a lot of competition. So I don't think it's the lack of ideas. I think it's more the execution of the idea and really understanding that sales and marketing channel. And I hate to harp on that, but if you have the best product in the world and you don't have a good sales and marketing strategy, it just doesn't matter.
Great. And then what do you think is the challenge the investor faces today?
Understanding, finding the deals that actually have that. I think here's the challenge. The challenge is the companies that figure out their customer acquisition costs and know their ARPU and customer lifetime value, they're not out advertising necessarily that they need the money. You almost have to find them. And now, do they need money? They probably are going to need money if they're growing rapidly, for sure. And you might find them on the street. But I think the challenge is really digging through the amount of companies. And there's been a surge, as you know, of people starting companies. After COVID, everybody figured out that they need a side hustle. Now, whether it's a side hustle or real business, I think everything starts out as a side hustle, but there's a lot of deals out there. I mean, I see a lot of, I don't know, I get deals every single day on LinkedIn out of the blue, which I think is sort of crazy because it's like grabbing somebody off the street and saying, "Hey, Hall, how you?" Or I don't even know your name. "Hey, Mister, you want to give me $10 for XYZ?" Like, I don't know that that's the right method, but it's cutting through that noise. I remember back in the day when I was sourcing for the two venture firms I work with, we had a lot of deals, but it wasn't this volume of deals that you need to go through really quickly. I mean, we were looking at the Inc. 5,000 list or the Inc. whatever the lists were at the time, and then using our network to find these deals. But now there's just so many, at least for me, it's been hard without having an associate to actually call through them candidly. And without that, I almost have just waved off. Because as you know, whether you're going to invest 10, 50 or 100,000 or 250,000 or 5 million, the diligence generally is the same, at least for me. That may not be the case for all people because they have a different strategy. But for me, it's really getting through that noise and then understanding, can I help? Because if I can't help, maybe I should just invest in a public stock company that is returning 19% a year and do that. I mean, I think that's the other thing entrepreneurs don't always take into account is who's their competition. Their competition are other deals, which there's plenty of, and there's the public markets that candidly are returning a lot of money for people.
Great. Well, you see a lot of different sectors and applications out there in today's market. If you had to pick one or two to put at the top of the list that you think are good opportunities, what would you call out?
Well, I think anything in the AI machine learning space is, I know a lot of people say that, but for me, I think there is a ton of opportunity. And even in old markets, the introduction of the ability to get through that data and make recommendations and see things that you didn't see before, I just think there's still a huge opportunity. I think there's a huge opportunity in space for sure. And I think there's some crazy things happening in healthcare, but candidly, as much as I like space, I don't understand it enough to invest in it. And healthcare, as much as I hope that they make you and I live for another 500 years, I don't know enough about gene therapy and all of this stuff to really make a bet in that. So for me, being more of a tech person, I think there's just still a greenfield in that space in industries that were old that are now getting modernized and have an opportunity to be disrupted.
Well, great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think we've covered everything, Hall. Yeah.
Yeah. No, I think it was a good discussion. So how best for listeners to get back in touch with you?
The best way is they can tune into my website or dial in my website at brandoncwhite.com. That's BRANDONC as in Christian White.com. Or they can tune into my podcast if they want. I'm on all the platforms. Just Google Build a Business Success Secrets podcast.
Great. We'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thanks so much, Hall. I really appreciate you having me on.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.